Right now, the jobs report revealing a huge number for the month of May, 339,000 jobs added, the unemployment rate ticking up to 3.7%. But the number of jobs added far surpasses, almost doubles analysts' predictions. And the market's reacting positively this morning to this news, along with the news on the debt ceiling deal. More on that in just a moment. But first, let's bring in NBC News business and data reporter Brian Chung and host of NPR's Full Disclosure, Robin Farzad. Brian, start us off. Break down these numbers for us.
Yeah, Anna, well, the numbers coming in blowout in terms of how many jobs were added in the month of May. As you mentioned, 339,000 jobs. That's how many were added in the month. And to contextualize it, that is well above even the pace that we had seen in the month of April, which was revised up to 294,000. The unemployment rate did take up from 3.4% in the prior month to 3.7% in the month of May. But again, this overall number does show that there's a lot of broad-based job gains. So where exactly did we see those job gains? Well, we saw it in these industries. Taking a look at professional and business services, adding 64,000 jobs, again, just in the month of May alone. We also saw job gains in healthcare, retail, trade added about 12,000, and leisure and hospitality up about 48,000 in the month. So again, a blowout jobs report well above Wall Street estimates and showing that the jobs market continues to be strong even this far away from the pandemic recovery.
So, Robin, what's your reaction to this report? And why do you think analysts have been so off with their projections in these recent months?
Well, why did everybody come into this year all the way saying that it's fait accompli, that we're going to be in a recession? It's been a surreal year with these massive bank failures, with wage inflation, with tip creep, and people polled on the street would say that the misery index is pretty high, as we've discussed before. But then you have Brian discussing these 50-plus year low numbers in unemployment. You have to duck to not get hired by the service sector, by the hospitality sector. And if you compare all of this versus where we were in the depths of the first couple of weeks of the pandemic, where unemployment, spiked up to almost 15% overnight. It's a real remarkable recovery. But don't forget that both the Fed and Congress threw trillions and trillions of dollars at this problem, and they still have to mop up some of that excess stimulus, and that's going to be really hard for the Fed to keep doing.
So what do today's numbers signal then to the Fed in terms of their next move after they keep raising interest rates?
Word on the street this week was that they might pause for the next meeting and see how the patient's taking the medicine. But I think this gives you ammo to keep hiking. And I don't know if the Fed thinks it can still land this economy softly, if we could get away without a recession. But look, it's deep. You see the wage pressures. You see this. You blew the numbers out this morning. And I think the Fed would gladly trade a point or two higher in unemployment. We're already so low to see inflation maybe slashed by 2 or 3 points, if that's even possible.
So, Brian, are wages any closer to matching inflation?
Yeah, well, right now, wages are not keeping up with inflation. And again, as Robin was talking about, this is the number that the Federal Reserve is really looking at in this report. So May, 4.3%. That's how much more people were getting paid in terms of average hourly earnings compared to May of last year. That's a bit of a slowdown from the 4.4% pace that we saw in the month of April. But when you consider that the pace of inflation is somewhere around 5%, that means that, okay, well, it's great that your wages are going up, but it's not keeping up with how much more expensive things are at the store. As the Federal Reserve hikes interest rates, it's trying to deliberately slow the economy to take inflation down, which might also take this down. But hopefully, as it does, get those things back into balance, at least for right now. Not quite there yet.
Robin, we mentioned that unemployment rate, that actually went up a little bit in this latest report. Why is that? And at this point, who has the leverage, employers or employees?
It's actually splitting hairs. It's inside baseball why the unemployment rate maybe went up 0.2 or went down 0.2 in terms of the denominator and numerator and who's dropping out and who's being counted. But certainly, definitely, irrefutably, the leverage is with workers right now. They can hold restaurants over a barrel. They can, keep planes from flying. This is such a roarback with service sector workers. We saw a great headline in the Wall Street Journal this week that never has it been so great for people who want to skip college and go straight into the service sector, because wages have really come up over the last 2 years during this inflationary period. I do think it does present an enormous problem for the Federal Reserve. Can you have this kind of growth? Can you have, 29 straight months? And the Fed hiking already 10 times and maybe wanting to hike 12 times? Can you possibly have all of this, have your pie and eat it too?
I hope so. I sure hope so. I love pie. I love cake too.
I got to tell you,
I love
Brian,
the frosting.
I think Brian must have fielded 1 or 2 job offers while we were having this interview. This stuff is so
I haven't checked my phone yet.
Real quick, before I let you go, Robin, I wanted to get your reaction to the debt ceiling deal being passed last night in the Senate. So it's made it through the House, made it through the Senate. It's going to the president's desk. Remember, Secretary Yellen kept saying a default would lead to economic catastrophe. How close did we come to that?
Performative fiscal policy. I mean, it's just performance crying wolf. So many times do they come up against this ceiling, this cliff, whatever you're going to call it. We've seen this play before, and I worry that we're going to see it again.